Let me ask you something. How many times have you looked at a chart and said, "Why did it move now? Why here? Why not earlier?" If that sounds familiar, you're finally in the right video. Today, I'll show you how to apply the EMA structure flow strategy, specifically the gold to USD pair, using real price behavior, real patterns, and real examples. Because I'm going to teach you a strategy that finally makes structure feel logical, not random. This is the EMA structure flow strategy, and once you understand it, the chart will never look the same again. When I first traded gold, I blew accounts, not because I didn't know indicators, but because I didn't understand structure. Gold punished me for guessing. It rewarded me the day I began reading flow. Here's what this session will give you: the ability to identify trend direction instantly, the skill to read structure like a roadmap, not a puzzle, a framework to enter at high probability zones, not random spikes, and a method to manage your trade with confidence, instead of fear. No indicators overload. Just structure, flow, and clean execution. Alright then. Open your chart. Let's build the framework. Open gold to USD pair on your chart. Any broker. Any platform. Add Exponential Moving Average, EMA, 50. Apply to price close. Add red color to identify. This is your backbone trend. Add Exponential Moving Average, EMA, 20. Add blue color to identify. This is the structure and the rhythm. And finally, add Exponential Moving Average, EMA, 8. Add your favorite color to identify. Yellow color is my lucky color, so I'm using it. This one will control timing and entries. And now we have our indicators in line. 3 moving averages. 3 rolls. 1 flow. Remember, gold respects moving averages differently than currency pairs. Price rarely glides. It jumps, then pulls back, then continues. Now, forget the indicators for a moment and look at this. A healthy uptrend creates a rhythm. Higher high, higher low. Higher high, higher low. A downtrend? Same pattern in reverse. Lower high, lower low, lower high, lower low. This rhythm is everything. If you can recognize this repetition, if you understand already, you're already ahead of 90% of traders. Before we trade this pair, we must understand its personality. Gold usually moves in cycles. Trend phase. Smooth rhythm respecting EMA 20 and 50. Manipulation phase. Wicks, spikes, fakeouts. Expansion phase. Fast directional move. Cooling phase. Pull back to structure. Gold loves to fake out impatient traders and reward those who wait for structure. Now here's where most people get trapped. Just because price is moving up doesn't mean it's tradable. A tradable trend must have consistency, meaning the EMAs stack in order. When the EMAs are flat or tangled, the market is confused. And if the market is confused, I stay patient. Because discipline pays more than prediction. Look here. Price is above the EMA 50. The 8 is above the 20. The 20 is above the 50. That's a clean bullish stack, meaning gold is trending. Higher high. Higher low. Another higher high. This is what a healthy uptrend looks like. Especially on gold to USD. Now watch this. Price pulls back. But look where it stops. Right inside the EMA 20 to 50 zone. Not random. Not coincidence. There's our rejection. That means buyers defended this level. A beginner mistake is entering on the wick. Never do that on gold. So when do we enter? Not at the high. Not when momentum is gone. We enter when price returns to structure. The entry happens only after confirmation. When price breaks above the rejection candle, showing strength. This area, between EMA 20 and EMA 50, this is your opportunity zone. Think of it like the riverbank, where price comes back to drink before continuing the journey. But we don't simply enter because price touched it. We wait for proof. Proof comes in many forms. A rejection wick, a bullish engulfing candle, a structure break, or a retest with momentum. There. See that rejection? Sellers tried, but failed. The next candle confirms interest, then breakout happened, then sellers tried again but failed again. Now, and only now, we enter. Gold has volatility. So stops must be logical and realistic. Below the rejection wick. Below the previous swing. A stop loss on gold isn't fear, it's insurance against manipulation. Stop loss is not fear, it's precision. Not too tight, not emotional. Just logical protection against randomness. Here is where most traders panic. They enter and the trade goes into a tiny retracement. Their heart beats. Their mouth shakes. But structure hasn't changed. The EMAs remain aligned. Momentum is still bullish. And there it is, the expansion phase. The smartest exit is never emotional, it's structural. Your TP should follow structure, not greed. 3 exit styles. 1. Fixed risk to reward ratio, 1:2 or 1:3. 2. Trail using EMA 8. 3. Exit when price closes opposite the flow. Your goal is not to catch the entire move. Your goal is to capture the cleanest part of it. Now let's look at a short example, because gold is often more aggressive when falling. Switching to bearish market. EMA stack bearish. Lower high lower low structure. Same logic, but in reverse. This strategy isn't just technical, it's emotional. Because once you see structure clearly, the fear disappears. No more gambling. No more chasing. Just flow. Gold becomes dangerous when it has no direction, avoid the choppy movement. When not to trade gold. This part is critical. Do not trade when EMAs are tangled, prices ranging between 5 to 10 candles sideways. High-impact news is incoming, especially NFP, CPI, FOMC, Fed speeches. Trading gold is not about prediction, it's about reading rhythm. You don't need to chase gold. You don't need to fight gold. You need to wait for structure, and then flow with it. Now it's your turn. Backtest it. Study the flow. Train your eyes. Trade with structure. Trade with patience. Trade with intention. I'll see you in the next lesson.